I'm Ian Castle, founder of Microcap Club, home to the best microcap stock pickers on the planet. Since 2011, our members have profiled over 1,300 microcap companies, with over 290 turning into multi-baggers. That's more than one big winner every single month for 14 years. If you share the passion for finding great companies early, before Wall Street and the institutions, Microcap Club is where you belong. Join us.
Now, was any of you lucky SOBs got tickets to the World Series game here? Anybody? Jeff? Would you like to trade those for some independent stock recommendations? We can do that. All right, actually, what a moment last night. I was actually on a plane from Vancouver watching the game on my laptop, and the pilot was announcing, made 4 or 5 announcements as the game went on. And it actually looked grim up until the 7th inning, and Springer steps up and smashes one out. And the plane went nuts. It was awesome. It was my little moment to get us to the World Series. That was awesome. It was very cool. Anyways, all right, there's our disclaimer. We do own shares, and I'm going to talk about 2 companies here today. It's going to be kind of a proof of concept is going to be the first company, and then I'm going to make a recommendation. But we like companies that have, one of the things that have made our clients money over the long term is to invest in companies that can replicate their success in one market into another and rinse and repeat. Simple businesses in Canada like Boyd, Expel, originally traded in the Canadian market on the Venture Exchange, and Hammond Power. Or recently, just 2 years ago, Planet Microcap held an event in Vancouver. We recommended this company here, but I think you can see it. This is Cipher Pharmaceutical. It's a drug company in the specialty pharma market. They in-licensed a drug into the Canadian market, the leading acne treatment drug for severe acne. At that point, they had 0% of the market share. Within 8 years, they had taken 50% market share. They're doing the same thing in the U.S. market, where they have a leading head lice treatment. While the shares are up around 300% over the past 2 years, we think that Cipher will go net cash again in the next 3 quarters, has years of organic growth ahead of it, and will take the U.S. head lice and scabies market over in the U.S. market over time. And who doesn't want a little more head lice in their portfolio? So this is Cipher over the last, this is 5 years, tremendous performance. That's our proof of concept. Why is it going higher? As you can see here, tremendous financials. This was their last quarter. Great revenue growth from the acquisition they made. They built up a ton of cash, used that, made an acquisition. That acquisition, the specialty pharma market, is not only providing acquisition growth, but growing quarter over quarter organically. These are in U.S. figures, so that 22 cents in Canadian dollars is about $200. So it's all right, making fun of my own currency, great. But as you can see, tremendous growth in terms of EPS as well. Our summary here, because this isn't really the company I'm recommending, we like this company long-term. It's a recession-resistant long-term business. Not cheap, but valuations are quickly moving lower, as you can see there, by the growth in the business we saw in the last quarter. It's still only around 13 times EV to EBITDA, fair value, close to in the near term, but we think it has long-term potential as they grow organically in the U.S. market with their head lice and scabies treatment. They have about 25% of the market right now. The incumbent has 75%. We think that'll flip over the next 5 to 10 years. Okay, we're going to look at Dynacor. Dynacor is headquartered in Montreal, so it's a Canadian company. It's a dividend growth stock, an industrial gold or ore processing company. They are a miller, not a miner. If they were a miner, we probably wouldn't be having this discussion today. They're engaged in gold production through processing of ore purchased from ASMs or small-scale miners. Right now, it's in Peru. They operate primarily there, where they work with ASM miners. The company has a strong net cash balance sheet. I'll show that in a second. And they're executing on a goal of putting out about 4 to 5 mills by the end of this decade. The company currently, like I said, operates primarily in Peru, where it works with government-registered ore producers in various regions of the country, primarily milling gold. They have a very simple business model. It largely depends on two factors: a margin between the price of ore purchased and the market price of gold. The higher the margin, the better. Throughput, the amount of ore processed, is better for the company. The higher throughput, the better for this business. All right, let's move forward. Why do we like Dynacor? Well, in the gold sector, you typically see profitability going like this over time. Dynacor has 14 consecutive years of profitability. Very strong balance sheet. Net cash is over 40%. It's about 45% of the market cap right now. Allowing it to self-fund its growth plans going forward. It's a dividend growth stock. We love small caps that grow their dividend responsibly over time. This is over the last 6 years, compounding that dividend at around 23.3%. We like to see that over time. It also has reasonable valuations today. Growth and diversification plan is in place, and I'll show you that in a second. This is the growth over the last 5 years. Good growth in revenues, good growth in underlying net income. Weaker Q2. This is your opportunity. Now, sales were up. That's due to the higher gold price, but tonnage was down. This was led by ore supply headwinds that were experienced in the northern areas of Peru. This has been sorted out. It should correct itself in the second half of the year. Net income came in lower because of that. Guidance was lowered, not on the net income line, but guidance on the production line, the milling line for this company was lowered. We think this is your opportunity over the next year. Our investment thesis here is really quite simple. They have that very strong balance sheet, $58 million US in cash, no debt, to buy and build new mills. They previously announced plans to open 4 new processing plants by the end of this decade. That would include Senegal, the Ivory Coast. They have their existing facility. They can expand that. It's 500 tons per day now. It can go up to about 600 tons per day, but it's not a near-term focus. The geographic expansion should come from Senegal, the Ivory Coast, Ghana, and a Latin American country, and we know that now to be Ecuador. They just closed a mill purchase there. They purchased a mill to retrofit in Ecuador. We estimate it'll cost around $25 million. $10 million of that has already been spent. It'll take 12 months, plant refurbishing and working capital. Then they can produce a mill that will mill about 300 to 350 tons per day. At full production, that equates to around 60% increase in their current production. We expect better grades from Ecuador than we see in Peru right now. Again, their existing mill is 300 tons per day. Within a year from now, they should have a mill up and running, self-funded, that has about 300 ton per day capacity. They also have, sorry, I jumped the gun there. They also have a test pilot mill in Senegal, 50 tons per day. We expect them to spend about $4 to $6 million to bring that online. It should come online in the first quarter of this coming year, so in 2026. It will not be profitable to start. It'll break even. The goal is to test the market in Senegal in baby steps. If successful, another 300 ton per day mill would be built in Senegal. Again, this will be self-funded from cash on hand and cash flow they expect over the next year. The company is also progressing with similar plans in the Ivory Coast and Ghana. Pilot plants still likely a year or more away there, however. Let's look at the valuations. Dynacor trades at relatively low multiples. It is a geopolitically risky company, so it should trade at a discount, but the discount is severe right now. Under 7 times EPS, 5.3 times X cash, so low multiples. If we just apply a 10 multiple to our estimate of earnings this year, around 53 cents per share, add back the cash, we get to a target of around 7.15. Upside if the company executes faster over the course of the next year or two. Near term, we expect lumpy earnings, opportunity to buy at a discount, looking 2 years forward, and collect the growing 3.681% dividend. Our effective yield from our initial investment on this company now is 8%. We expect that dividend to compound over time and grow that effective yield. Dynacor is, again, not a traditional gold producer. In fact, it's not a producer at all. It's a miller, industrial ore processor. You got to think about it that way. As such, it has not participated in the gold boom in 2025. We do not expect the price increase to benefit the company. But we also do not expect a decline in gold to significantly affect the business. Either the beauty of the model is it can be profitable in up and down gold markets. The current share price slump appears to be an opportunity. We're expecting messy kind of earnings because of the CapEx over the next 1 to 2 years. Again, this is your opportunity to buy, and they should come out with production increase about 60% within 12 months from now. And then you could have another significant increase 18 months from now. We think it's growth, it's a reasonable price. If it's one stock in your portfolio, you're crazy. If it's one of 15 to 25, it makes sense in an overall portfolio. There is our disclosures, and thank you.